I'm going to get started, and for folks that are late arrivers, we'll try to make a majority of this deck available in the form of a PDF for those that are interested. So let's get started. Thanks again to the team for having us here, and including US SIF. This is a strange new normal for everyone. My name is Michael Young. I've been with the US SIF team since the fall of 2016. And I head up our education programming. I want to tell you a little bit about US SIF for those that are unfamiliar. We are a membership organization that has a membership that manages more than $3 trillion in assets. And the membership ranges from asset managers that you might know from the mutual fund or ETF space to separately managed accounts. There are some foundations and other asset owners. There are research, data, and index providers that you're familiar with, like Morningstar and Bloomberg and MSCI. We have large broker-dealer members. We also have individual advisory practices that have joined us. Community development institutions, which I think will really tie into some of the audience today, working with the Impact PHL team. And of course, we've got some other nonprofit organizations in our universe. If you aren't familiar with US SIF, after today's presentation, be sure to visit our website. I'll mention it a couple of times during the slide deck, but we'd love to have you get involved with our work for those of you that are in the field. And for those of you that aren't, we try to create materials that are accessible for all aspects of the investable universe, meaning if you're an individual investor, we come up with tools and guides for you, whether that's engaging with financial professionals, the questions you want to ask them, or talking to your retirement plan to try to find a way to get more sustainable assets available to you in your 401k or 403b, all the way to those of you that are yourselves financial professionals. We've got guides for asset owners, asset managers, as well as financial advisors, and I'll share some of that later in the presentation. Broadly, what we do is work on research. We'll highlight a big research piece that comes out every 2 years. Education and training, as I just mentioned, we work on public policy, so you'll see some of our team in DC is working on the Hill. We're reaching out to the SEC regularly. We're offering guidance and hopefully making progress, particularly in the coming years as so many things have changed for individual investors and shareholders. We generally hold an annual conference. This year we were sad to cancel it due to COVID-19, but for those of you that do go to conferences, we hope we're back in 2021. We'll be in Chicago next year, and we really look forward to seeing our friends in person again. And then finally, we try to engage the media, whether that's print media or very often online, as well as trying to become part of the social media education for folks that are looking for more information. Now, I'm going to cover a couple of things today that will maybe on the surface potentially look like financial advice. They are definitely not. I'm using them as examples. If you have questions about this, work with your financial professional. I am not endorsing any particular strategy, but I do want to make sure that my examples are kind of granular, so you'll see a couple. So this is my disclaimer. Okay, so let's jump into it. We are 7 minutes after the hour. Hopefully, I've seen a few more people log in. Let's talk about what sustainable investing is. So you can see the definition here on the screen. And what I would say for folks generally is sustainable investing has had many monikers. You've heard people call it socially responsible investing. You hear impact investing. They're often used interchangeably. There are some differences. I have a slide coming up that'll show you a couple different ways to think about it. But generally speaking, what people in the sustainable investment space are looking for is consideration of impact upon environmental, social, and corporate governance criteria. And if all goes well and you are doing things correctly, and as a professional sustainable investor potentially could guide you, you're getting competitive financial returns, but more importantly, those returns are considering externalities and offering positive societal impact, which is not always the case certainly in traditional investment. So responsible investors have two potential approaches, maybe three, but I'll talk about the two we have on the slide here. The first is considering those criteria, and we'll jump into specifics of what they entail. But essentially, some ESG data is material, but not necessarily financial. And so when you're trying to assess risk, somebody who's just looking at corporate balance sheets or just looking at the data that a company may share, they may not be considering environmental, social, and governance criteria, which could indicate opportunities for performance, or more importantly, for those that are risk adverse, uncovering risks that maybe don't show up in traditional financial analysis. The second part is for those in the publicly traded space, so dealing with the largest companies in America that are available on the exchange, active ownership. And what that means is at a base level, you're voting proxies, which often cover executive compensation. And we've seen some pretty egregious examples recently, even in the downturn where we're seeing layoffs, and potentially filing shareholder proposals and shareholder resolutions with the idea that you're going to influence the board to potentially change the practices of the corporation for the better. And in some cases, we see large shareholders, even recently, voting against renewing board membership, and or even suggesting the replacement of a chairman or a CEO. And that is very active ownership, but not common from the very large asset managers. So we're seeing some changes in the space. Now, I said they're used interchangeably, but I do want to highlight impact investing, because if you are in the Philadelphia region, familiar with the Impact PHL team, I want you to know about GIN, the Global Impact Investing Network. They, of course, have a very similar definition to US SIF, but one of the things that I want to talk about is some people view impact investing as direct investment in your local region. And often that is a lending structure or a note structure or direct investment into a project as a underwriter. But the idea is, while you're seeking financial return in your local community, you're also looking to make sure that social impact is measured. And I think that's a real key component to understanding sustainable investing and how impact investing works, is that it's not just that you want to do well financially or do the right thing, but you also specifically are seeking to measure risk and measure the impact afterwards. So I mentioned some of the research that we do as an organization. I just saw my CEO, Lisa, log in. One of the people, Lisa and Trevor, your video is on, just so you know, if you both want to hide. But we do a research report every 2 years. It comes out usually around Halloween. I think this year it'll be mid-November. And this report started in 1995. It is the report on sustainable, responsible, and impact investing. We call it internally the Trends Report. And 2018 had some pretty interesting numbers. Now, if you're not familiar with this report, take a look at the chart on the left side there. You'll see that the numbers were gradually growing, but sort of a slow and steady pace. And then in 2012, we saw sort of a hockey stick event where the acceleration is very exciting for those of us in the field. And I'm interested to see the numbers that we come out with in November of 2020 when we publish the next report. But it's $1 in $4. So for those of you that are new to this field, or for those of you that are students that are maybe just learning about it, this is very exciting for those of us who have been in the space and have been waiting for the industry to catch up. And what we have seen is the most sophisticated professional investment firms across the world are integrating these ESG criteria data points into how they invest, because they're recognizing it offers more risk analysis and oftentimes is helping deliver returns. And we'll talk about returns specific to even this recent downturn in a little bit. So one of the things I want to explain in the report of this huge $12 trillion number, that makes up essentially a quarter of all the professionally invested assets in the United States, is who's doing what. And so this screen gives you, this current slide gives you a sense of what it is. Shareholder resolutions are not a huge part of it, but that doesn't mean these companies are not being engaged. So there are impact investors or responsible investors or sustainable investors, whatever terminology you want to use, who are talking to these companies and trying to get them to improve their practices, both from a risk mitigation standpoint, but also because we want them to account for societal and environmental impacts that hurt the rest of us. So there's a long history to sustainable investing, responsible investing. You can actually go before the 20th century, but I just wanted to highlight a couple of big events, particularly 1973. You'll see that Community Development Bank. As you think about regional investments, impact investments, let's say in the Philadelphia area, these are the types of organizations that are now available across the United States and internationally. These development banks, these CDFIs, sometimes you'll hear the acronym, are ways for investors to get involved in helping the community that they live in. And you'll see the last thing I put on here before the turn of the century was the first US SIF Trends Report. And of course, we will have another one in 2020 in about 6 months. So ESG, since I mentioned it, what's in ESG? What are the ESG criteria that these companies and investors and stakeholders might be considering? And so hopefully you can see this on your screen, depending on how you're accessing this, but you'll see there is something like pollution and toxics, where we want to have a corporation measure the impact they're having on the environment where they may have offices or factories or plants. And then additionally, we want to understand their carbon footprint. What are they bringing to the world by transporting their products? Social, we're talking about labor relations here, workplace benefits, what community development projects they may or may not be involved in. Is there workplace safety? Are they considering human rights? And so forth. So I won't dive too much more into it, but I want you to understand what that is so that we can talk about how are investors using the ESG criteria. So one potential way they could do it, which was the first way many people did it, which was negative exclusion investment processes, meaning that they would say, hey, we do not want to invest in weapons. We don't want to invest in, let's say, fossil fuels. And so please remove those from the portfolio, but otherwise I want a standard structure. That still exists today, and in fact, we have seen targeted divestment even offer better returns over the last 5 years, in particular when it comes to oil and gas. Another approach to using this ESG criteria is to focus on the best in class. So you're ranking, you can use data providers like MSCI, S&P, Sustainalytics, Morningstar to uncover best opportunities. The companies in these different sectors that are performing best across ESG criteria. ESG integration, so I've got that listed as well. That's another approach. So essentially, the ESG factors go into the broad category universe building. So if you're buying bonds or stocks, something broad, you are basically saying, hey, we have specific ESG factors that we rank equally to some financial factors. And that system may exclude individual companies, but not directly as you would with the negative exclusionary approach. It would just be that they didn't score well enough to get into the portfolio at a given time. And then lastly, you do see many sustainability themed products available as mutual funds and separate accounts, and they may have a targeted focus. So it could be gender equity, it could be direct assets into water investments, et cetera. So I like to share this screen because for those of you that have any sort of investment portfolios, particularly those of you that are financial advisors, a question that comes up is the process any different, and does what you end up with look any different if you're building a model portfolio? The short answer is no, these are supposed to look the same. the approach is the same. Every client, every single investor, their decisions are going to be made by their goals, their time horizons, risk tolerances, what's suitable. But the good news is, because of the fast adoption of sustainable investments, particularly over the last decade, there are many choices available to you. So you have all kinds of mutual fund and ETF options. There are many managers that have been in this field since before 1980, but even now you have products that have 20 and 30-year track records that you can look at. And we're seeing the performance is very competitive, which I will get to. But let's jump into performance, because I'm looking at my time and I want to make sure I leave some opening for Q&A, since we've got a mixed audience and people may have very different types of questions they want to ask. So I've got a couple of different charts. Some of them are a couple of years old. I will get to the current COVID numbers in a moment, but I just want to share, there have been investors that have come to me since the early part of last decade. We still have this with financial professionals that we engage with. They ask us questions like, yeah, but if we do this, if we care about our impact on society, or we care about measuring our negative constructs on the environment, aren't we giving up financial returns? Isn't that what most people care about? And the truth is, you're not giving up financial returns. So you can see this chart, which goes back to coming out of the financial crisis through September of 17. And you can see that essentially the ESG version of the MSCI ACWI, which is all stocks in the world, slightly outperforms over that entire period of time. Here in the United States, I'll just pick on the S&P 500 because we have seen some pretty bad news the last couple of days and certainly the last 4 months. And you'll see that KLD, which is an index that you can buy as an ETF, but it's essentially 400 companies. It has existed since 1990. It has outperformed the S&P 500 since 1990. Now, this chart ends in 2018, but it's still true in 2020. This slide often surprises people. I would just share with you that you can find this in almost every asset class. So here's another way to potentially look at it for folks that are saying, okay, those are just absolute returns, Michael. What about risk-adjusted returns? Does it work? And the answer is yes. And I'll show you another one. How about for fixed income? Does it work? And the answer is yes. There is no asset class where including environmental, social, and governance data items offer some additional performance. Sometimes that performance is just avoiding losses, but it's very exciting and it's comprehensive. So for anyone that had doubts, I'm going to show you in a couple of slides. There are many studies. You can look at this. You can pull up the charts you like. But I wanted to share something that Morningstar put out, and John Hale has presented on a couple of times since the COVID crisis has begun. But you can actually see in the first quarter that sustainable funds outperformed traditional competitors. And this was also true down to individual stock selection, because some people said, well, isn't the issue that oil was down quite a bit, and that's the reason that we're seeing less performance, let's say, from traditional indices that have oil holdings? But the answer is that's not the reason there's been outperformance. Stock selection has driven the vast majority of it. And so if you haven't heard John Hale speak on this, I would recommend folks to use some of the Morningstar assets that have come out, when I say assets, materials that have come out since COVID-19 has started. If you want to see more specifics on how this is working in practice right now in a way that is making a difference for investors. And we hope what will happen is the companies that have chosen not to focus on their own sustainability recognize that if they internally start considering ESG criteria, they might improve their own returns and get included in more funds. So let me jump to this. I mentioned at the very top, if you haven't been to our website before, you'll find a lot of different materials that could be useful to you. There's one that collects research from both people in our membership and from our own team, and a lot of it focuses on performance. So you can find performance studies and meta studies And I'd recommend going to the site. I won't run through all of these on the screen right here. But what I would say is if you haven't looked at this or you have any doubts, you'll find a bunch of empirical data that'll show you performance is not only achievable, but in real time it's happening, and it's happening in a way that is convincing skeptics or people that have been skeptical for a long time. So I mentioned the trends report earlier. There's also a global report that comes out usually a few months after we put out trends in the United States. And what you can see is that while in the US we've had a great trend, Europe is still the leader in the world, and we've seen very fast advancement in Japan. So if this is new to you, you should know that it's happening around the world. We are actually not a leader in this space, but we're getting there. Some of our asset managers have global footprints, but it's quite exciting. We're seeing it across the world. I want to share another organization that if you're new to the field and have never heard of it, there is PRI, Principles for Responsible Investment. They are a global organization that originally came out of the UN, and they put out great educational materials as well. And if you're not familiar with their work, be sure to visit their site, because they are going to be a part particularly of emerging market development, which for those of you that are direct impact investors or wanting to learn about it, you will see direct investment options that range from working in cities in the United States to improve access to food and transportation and healthy lifestyle, to agrarian communities and emerging markets that are more concerned with clean water and access to power. So where I want to lead that to is, and I wish I could ask a question to the crowd, but it doesn't quite work in this format. But the Sustainable Investment Goals, the SDGs. If you're new to this, or this is a refresher for you, or you're a financial professional that has decided this is something I want to learn more about, and I want to integrate it into my conversations with clients and colleagues, how do I frame these conversations? Well, I think the SDGs are one great way to potentially turn what sometimes is complicated into layperson conversations. If you want to explain this to a family member or somebody who's new to it, what can you do with private assets? What can you do with public assets? What can you do with partnerships to address these 17 goals that if we were able to properly address them all, would make the world a more just and healthy place to live. So if you haven't visited that website for SDGs, be sure to do it, or follow them on social media, and you'll learn more about specific areas that may be of interest to you, or projects that you want to work on, for those of you that are students and going to be entering the workspace soon. So I want to share, before I open this up to Q&A in 15 minutes or so, or 10 minutes or so, let's see. The opportunity, because we have seen a lot of changes in the field, and from the slide that I showed towards the beginning with the hockey stick, where we saw now 12 trillion in assets in the United States, there is a huge opportunity. And most asset owners have started to consider ESG integration, but this trend is moving pretty quickly. This survey was from 2018. I think there will be another one later this year, and I won't be surprised to see that, yes, across the board will still be the leader, but that it'll be far beyond 50%. What that means is the most sophisticated investors on planet Earth are seeking this for their clients, who are demanding more than traditional financial returns. We are seeing pension funds integrate this. So these numbers are a little dated, both good and bad, because we've had some losses from the market. But I want to point out that I mentioned earlier that this isn't just happening in the United States. Look at these numbers. Japan's pension investment, Norway, South Korea, the Netherlands, China, Canada, Singapore, and of course, even our large pensions like CalSTRS and CalPERS. So it's happening. There are folks that are new to doing this, and there are pensions that are still not sure if they want to do it. But what I'd say is that the leaders in the field have already been doing it. And this is a great sign because hopefully it leads to retirement accounts for those of us in America having more options so that we can do the same. So this is probably the biggest bummer slide I've got to share with all of you today. If any of you are a financial advisor, this is your opportunity. For those of you who are private investors or maybe have a financial advisor, this might illustrate why you've got to start a conversation with who you work with. There is a disconnect. We are finding that investors themselves want this. They want an integration of environmental and social impacts measured alongside corporate governance issues that could hurt financial performance. But financial advisors are not bringing up the conversation with their clients, or they're not integrating or offering enough products to their clients. So if you find yourself on either side of this, make sure to connect with the people on the other side, because it is the largest American opportunity, is getting financial advisors to take more action from what people want. So for those of you that are new, or this is the very start to you, what I would say is you can ignore the clients for those of you that are individual investors, but for those of you that are financial advisors, maybe how you think about it. But for everybody, find the issues that are important to you. There are tools all over. Most of them are free that can help you figure out what issues and what values you'd like to see represented in how you invest. So you can go to an organization like As You Sow, and you can actually use their Investing Your Values tool, which is free online. You can type in any of the symbols of the mutual funds you have in your retirement account, and you can uncover whether you have exposure to guns, or if you have exposure to fossil fuels, or if you have exposure to deforestation. And if you have any of those things, and those are hot topics for you, you can then start the process of seeking a replacement, a fund that maybe addresses those items directly, or at the very least, make sure that you're not invested in things that you don't want to support going forward. So the second thing is, walking your talk. So for those of you that are already doing this, let's say as an impact investor, for those of you that are asset owners, you're doing local investments, or for those of you that are maybe listening as endowments, are you investing everything else you do in the same way that these individual projects that you're working on might be invested? And if the answer is no, you've got to address it, because there's no time to waste. I mentioned guides at the beginning, so this is one of the last things I want to bring up. If you are a financial advisor, this guide is free to download on the US SIF website. It'll give you sort of a step-by-step process on how to consider integrating sustainable investments and impact investing into what you do for clients. For those of you that are clients and maybe have a financial advisor, you can use this guide to talk to your advisor and get them on board. We also have guides, as I mentioned, structured very similarly for asset owners and for asset managers. So if you work for a firm that is new to the field or building products for the first time, if they're not engaged with US SIF, make sure they do engage with us. We can either guide them as new members, or at the very least offer them ways to improve their practice by following some particular guides or investment courses. And then I want to share something else, because this is really important, the professionalization of the space. There are people that have been working in this field for 35 years plus, and they are experts. But there are a lot of folks that are entering for the first time that are looking for a way to ramp up their knowledge and can't gain 30 years in any other structure. There are now even professional designations. This first one was created by US SIF and the College for Financial Planning, and it's available for anyone that's a financial professional. We've already seen, since this launched in the fall of 2018, 161 people earn this by passing the final exam. We've seen hundreds register to sign up to take this course and criteria in the last, I guess now, 16 months or 17 months since launch. So it's very exciting. And there are other designations, not just in the United States. There is a designation for CFAs in the United Kingdom. For those of you in Canada, There is a credential that you can get through a university structure. But I think we're going to see more of this, and I think we're going to see more sustainable investment education get integrated to existing designations. So that is great news for all of us. So I want to leave you with some last thoughts, and then I want to open it up to Q&A because we've got quite a big group, and a lot of people clicked other for what their background is. So some of what I've covered may not be in your wheelhouse. And if we need to go back to slides, we can do that. So listen, this is straightforward. You can do this as an individual. You can do this as a professional. You can bring about positive change. You can diversify portfolios in all asset classes and investment vehicles. Not only is performance competitive in some scenarios like we're experiencing right now, it's better than average. It's outperforming. You can meet fiduciary standards for those of you that are stewards of capital. And, you know, we said $1 in $4 is a very exciting number, but that means there are 3 out of $4 that still need to take the step. So every dollar matters. Even if it's the small incremental investments that you make in your retirement account with every paycheck contribution, you got to make sure that you've got options in your plan. We have guides for that on the US SIF website. And for those of you that are individual investors, we have a free course coming very soon that you can take online. So with that, I want to see if anyone's got questions. I don't know what the format for Q&A will be, if it'll be through, and maybe Diana can tell me this. Diana, are the Q&A questions supposed to be entered through Zoom, or are they supposed to do it through the Pathable page in their browser?
Great. Well, everyone can keep on sending us questions through the Pathable chat. And Michael, if you're okay with it, I can read them out to you.
Sure, that would be great.
All right. So we've got a couple of really good ones. Hopefully we'll have time to get through them. I think a lot of people would like to know, what are your views on tackling risk and, you know, trying to deal with impact measurement, and what do you look for to make sure you're maximizing the investment and also minimizing the risk?
Sure. So can you repeat that one more time? I want to make sure I catch all the different components of the question.
Sure. I'm trying to combine a bunch of them here and try to make sure we cover what most people are looking for. So I think one person put it well. What data do investors ask for or look for to make sure they're really maximizing their investments and measuring the ESG impacts?
So it's a great question. It is a complicated question because you've got a bunch of potential inputs. So it depends on your asset class. So if you are, let's say, looking at a publicly traded company that is a tech company, the questions that they're going to ask are very different, or the questions that they'll be asked or that investors are looking for can be very different than a publicly traded company, let's say, is an oil company or a manufacturer. Because there isn't necessarily a lot of environmental impact that can be measured on the tech company other than potentially energy use. And so that may not be a high criteria point for ranking whether or not this company is doing a good or bad job from an ESG perspective. Whereas, you know, an oil company or a fossil fuel company or a manufacturer, toxic waste, environmental impact is a direct bottom line issue that the bottom line falls on taxpayers. We pay for them. We pay for the externality that the company maybe doesn't at the moment. And so those questions are not easy to answer. What I would say is, if you're a financial professional, really if you're anyone super interested in this, there's an organization called SASB, S-A-S-B. And if you Google materiality matrix or materiality map, there's a free tool that you can access on their website, and they actually break down industry issues. So if you want to figure out, hey, I'm specifically looking for XYZ industry, and then within that, I want to know what are the top questions that we should be asking, what criteria questions are the most important in terms of their relative ranking in their peer group. That'll break it down for you. When it comes to fixed income or direct impact projects, that's also pretty nuanced, and it does depend on where you're allocating capital. But the measurements might be, you know, how much affordable housing are you creating along with a potential multi-use real estate project? Are you working with local stakeholders to make sure you're accounting for environmental impact with the building project itself? Are you working with organizations like the Green Building Alliance, or are you getting a LEED certification? Are you doing something that, from an investor standpoint, if you're a direct impact investor and looking to be part of the lending, are they accounting for the different items that matter to you? And more importantly, whoever the project manager is, do they have these as itemized pieces that can be measured over time? Will there be monitoring? So it is really project by project, but I would say for those of you that are looking for more specific information, I'd be happy to spend time offline answering questions that you might have about the specifics.
Excellent. So this was another question that we all thought was pretty interesting. What are your views on tackling the risk of emission drift by commercializing the social sector? Is there any real risk that focuses on bottom line could impact the social venture's actual mission? And how do you sort of deal with the different beneficiaries there from a financial perspective and from, mission-driven perspective? How do you balance?
So that's a great question. That is beyond a 101 question. So hopefully everybody this maybe isn't in your wheelhouse. I don't put you to sleep. But the short answer is it is about leadership. It is about what your particular mission is. It can be challenging to meet the demands of multiple stakeholders, but it depends on your organization structure. Meaning, is your mission engaging with multiple parties? Are those parties all very similar? Are you a membership organization? Does everyone have an equal say? What are the inputs? What are the drift? You have to define what do you believe the drift is. I hate to speak in such generalities, but not knowing what mission you're talking about that does make it hard to answer for a broad group like this. But that is a next level question. It is what many people are talking about as a result of all these new assets coming into what are being defined as sustainable investment vehicles and asset pools.
Excellent. Sorry, I was muted there. So another couple of people are asking how you recommend kind of understanding this information when you're someone without financial experience. So are there other resources or other ways they can get involved if you're not someone who's been a financial professional or been actively engaged in investing?
Yeah. So great question. There are lots of tools available to you that I think are pretty accessible, even if you don't have background in this. So, for starters, what I would say is visit the US SIF website. You'll find quite a bit there that while we do try to speak at a high level, for some of our material, we do get granular with certain parties that we interact with. But what I would say is you'll find that more and more organizations are making tools available to you. So I mentioned As You Sow, that's ASYOU, ASYOUSOW.org, I believe. They've got an Investing Your Values tool that I mentioned earlier, which I think is great for somebody who doesn't have a background but does have mutual funds because they've got a retirement account. It's a great way for you to uncover what you are an owner of. And you may find that it doesn't align with what you'd like to see happen, and that's the first step. I see Heather put the SASB material map link on the site, so thank you for that. The other thing I would say for that question about getting more information accessible or simplified is we're going to have to see more materials come out. So US SIF is creating a free course for individual investors that they can take that links out to many of these tools and guides that would be available and free to even people without any financial experience at all. And I think we'll see more of that. This is, while it's a field that is growing quickly, we're finding that the demand continues to grow, and as a result, we're probably going to see more and more organizations try to make accessible materials available and available free. Lastly, you may find that if you're affiliated with a university, there are more and more tools and resources available to you as a student that can maybe get you on the right path to understanding where you want to go potentially in this field, even if you don't have a background that's finance particular.
Here's another good one that I really like, and I think this is probably a good way to pivot back to a different part of the discussion and speak to some different people here. While investors might be ready to make the investment, social ventures might not be ready to receive it. So in that case, how can we as stakeholders, and what can be done to try to get social ventures ready to take an influx of investment?
Okay, if I'm understanding the question correctly, let's take Philadelphia as an example. It's a great question, and I would say the support that you can receive potentially, or your ability to collaborate with others who have already made advancements can make a huge difference. So I know that the Impact PHL group, if you haven't engaged with them before, you might find that if you've got an investor who is ready to step forward, but the projects that they're looking for don't exist, you may find that these networks have incubated ideas and or can guide you to existing ventures that you just weren't aware of. I think it's a big challenge, for the non-public investment vehicles to find what you're looking for, unless you know the community that you're investing in, or you know within a specific geography what kind of project you're looking for. So, one of the things that you could do besides engaging with the community around you, if there is one, not every part of the country has it, is to look for organizations like IEN or look for CDFI groups. You could even go to national organizations that have members or experienced parties that are in their membership that can help you figure out what the next step might be. Maybe they can connect you with particular capital or investors that are working in the field. So Green America is an organization that you might consider. But again, this is one of those where I feel like for this 101 group, that is a great question, and I would be happy to spend some time privately offline, but I want to hedge away from specific investment advice, and this dives into the question of, I think, a little more than we would want to cover today. But I'm happy to spend time with you.
Excellent. Here's another one that might be very topical for us to talk through today as we talk about the new normal. In the midst of the COVID-19 pandemic, do we think that sustainable investing might be taking a backseat, or might be actually rising to the forefront compared with other funds?
It's a big concern. So what I'd say is, and I'm not seeing the questions come through, so I'm hopefully answering them well, but I think I'm stuck in the Zoom view, so my apologies to everybody. But it's a big concern, right? Because we may see that from a regulatory standpoint, as you see, let's just take COVID in the United States in particular, Congress taking action and maybe not putting any thought to what kind of outcomes we want on the other end. They may not be considering where capital will go. They may not be considering what types of industries that they're propping up that maybe already were struggling and now they're just bought time. We may be seeing some people who maybe are potentially a little more cynical in government that don't want to make advancements on environmental impact, and so can use this opportunity to for cover. But what I would say for the professional investment community is Pandora's box has been opened. When I look at fund filings, when I look at asset flows, I'm seeing the opposite. I'm seeing that there are lots of new assets coming in. The fourth quarter, and then again this first quarter of 2020, had record inflows into mutual funds and ETFs that have some sort of sustainable investment approach, whether it's an ESG integration, or even if they're just an ESG tilted index, which may not have as much intentional focus. So the assets suggest that's not happening. from a government perspective, it's definitely a concern. And I wish I had a better answer than that. We'll have to see how it plays out. But what I would say is that the companies that are have already considered their own sustainability over time have been performing or better than most of their peer group, depending on the industry. And the funds have been outperforming, as I mentioned earlier, and the asset flows are following. So I don't think it's taking a backseat at the moment, but there may be some issues with where we see bailout funds go, what sort of industries they end up helping, even if unintentionally, that could potentially have an environmental outcome that is suboptimal for those of us that care about this.
Excellent. And keep the questions coming, everyone. We have about 10 minutes left. I do have another one.
Sure. I just want to say I was trying to think of some other resources that are out there. There's a lot of great, and they link from our website, but there are a lot of great organizations that I haven't mentioned. So if you haven't heard somebody that you're maybe engaging with, don't take that as a non-endorsement. There are great organizations like Tonic with 2 I's, if you're not familiar with them. They've got educational materials that I think are quite good. And I'm sure I'll think of some others in after we all hang up. But you can link to quite a few resources out of the US SIF page, and again, you can connect with me separately afterwards. Either go to our website, you can track down my information, or if you're able to pass that along to everybody, Diane, I'm happy to take individual questions afterwards.
Excellent. Well, thank you so much for being so generous, Michael. We appreciate that. So another question we have coming in is how companies can balance having kind of a need for the short-term quarterly returns that the CEO will need to deliver, in addition to the kind of a longer-term horizon of most ROI from ESG investments.
This is a great question, and I think it frames, particularly in the publicly traded equity space, everything going forward. And we've seen some leaders in the field make statements that they recognize this is an issue. You have some companies choosing to not give forward guidance more than once a year. You see asset managers like BlackRock CEO Larry Fink actually write letters to investors and to shareholders, basically describing the fact that short-termism is the issue. You have that corporations need to be thinking about the long term, not just because of their quarterly performance needs, but specifically because the company may not exist. We're seeing now, publicly traded companies don't last as long as they used to. The numbers are actually shockingly low when you do the research. Additionally, corporate executives, in particular CEOs, have generally very short timeframes in charge, and their compensation packages maybe need to be restructured, because if they're paid for just the time they're in leadership, which for most is less than 5 years now, it's hard to not imagine that all they would do is focus specifically on what they can do for themselves and for the next quarterly report. But I think what we're finding is that if you're integrating ESG criteria into your reporting, into your corporate sustainability report, how you are engaging the asset managers that are potentially including your company in their portfolios, you're starting to make decisions. When I say you're, as a company, they are starting to make decisions that are more long-term oriented, but it's definitely something that isn't happening enough. So it is, hopefully, we'll see more of it coming out of whatever the new world looks like post-COVID, that more and more corporations will spend their time thinking about that long-term perspective. And then importantly, because I think we learned this with Wells Fargo and the many scandals that they've had, but if you don't align compensation, with, not just for chief executives, but all the way down through the company, if you don't align compensation with the type of societal outcomes that you would like, naturally what's going to happen is people are going to pursue, and they're an egregious example, but they're going to pursue maximizing their own pay and not thinking about long-term impact on society. And so, that's got to be aligned. and a lot of companies haven't done that yet. And it's not easy. So I think it's going to take some time, but it is being taught more. And I have hope, but it's definitely something that hasn't happened yet, or enough of.
That is an excellent point. That is probably the key challenge right now for ESG investing. I'm not seeing any additional questions. So if, does anyone have anything else that they would like to ask, or if you haven't dropped into the session yet, Michael, are there any final comments you'd like to make, or things that you think everyone needs to know about ESG?
Yeah, I guess I'll keep it short because I know people have other sessions to go to, but I want to thank everybody for taking the time today. As I mentioned before, some of the resources that I mentioned are available for free, but what I'll do is work with the team that has put all this together to make sure that there is a PDF you can pull down, and that my contact information is available for anyone that has individual follow-ups they'd like to make. I probably wouldn't have said that if there were 10,000 people in the session, but it looks like a manageable number, so we can do it. If this is your first step in the space, if you haven't done anything but attend today's webinar for your first time in, know that you took an important first step, and there are better experts to listen to, more and more materials available by the week and the month. And that this is easy to do. So don't be discouraged. There's plenty of resources, and you can make a big difference even by just making individual changes in your own life.
Great. Well, thank you again, Michael, for being so generous with your time, for walking us through all about ESG and impact investing. And with that, I think we will close the session. We have a couple of great ones coming up later, so please stick around with us. And thank you, everyone.
Okay. Thanks, Diana.